and I like the name, Shikara Investment Management, right? And Peter is also there. Hello, my friend, long time.
Hello, Nikunj.
Hello.
Good morning.
All right, so Peter, I've been reading your notes, and I was reading those notes, I must say, even when I was on a holiday. You've been writing a lot on the oil impact and how oil, in a sense, is unlikely to sustain despite the geopolitical tensions. But given that we have a new dimension now, which is that America has entered the war, will oil flare up, or will oil just see a mild spike and then come tumbling down?
Well, Nikunj, I've listened to both of your introductions, and I feel as though you're pretty much on the target. The issue, I think, everyone's mindset is how long does this drag on for, and what is the time frame? If this was to be a very short-lived encounter and things get back to normal and we're here this time next week and it's just a blip on the radar, or is it something that really starts to bed in and becomes far more long-term? And these are the issues. And once you've got the Strait of Hormuz and the issues there as far as tanker, from a distribution choke point, then that really creates a lot of angst to market traders, and that could certainly push prices up considerably from here. So it's all an unknown at the moment.
So would you say crude will come down, or crude will stay where it is for an extended period of time? Because if it stays where it is also for an extended period of time, it's actually bad news.
Absolutely. You know that. I mean, we've discussed that 100 times together over the years. Inflation is the curse. And if oil prices were to stay up or elevated from here, then that really is a handbrake for the global economy. I think that I want to see, and I think every market trader, I look at it from the lens I look at it, first off as a trader, I want to see the time frame of how this plays out over the next probably 48 to 96 hours, where we are on Friday. And if it was to ramp up from there and there were further issues as far as Israel and the US being further involved, then that changes the footprint from a geopolitical standpoint and, more importantly, the fabric of the Middle East. So, but if it's over by then, and that's the issue, the other side of it, then I'm sure that the market will retreat fairly quickly from here.
All right, we also have Rahul Chadha with us. Hi Rahul, good morning. Great to be speaking with you. Help us understand what's your take on the escalation between Iran and Israel and now US entering in. How do you believe that the markets will trade on this?
Yeah, no, I think markets would, as the discussion was going on between Pete and Nikunj, markets will watch how the situation evolves. So would you see the other kind of an oil infrastructure facilities in the Middle East GCC region getting attacked as a retaliatory measure? Would you see other powers being drawn into it? We've seen some statements from Russia. China has been quite here, but do we see the traditional supporters for Iran kind of get drawn into the conflict? If it remains a bilateral conflict or three-party conflict between US, Israel, and Iran, I think that should calm markets. And if we have a couple of retaliatory attacks from Iran on Israel and things quieten post that, then that should calm the market.
Right, so that's the take on how the markets could react to this. But Peter, we're reading notes and we're hearing chatter on the street that if this escalation were to continue and if Iran were to hold the Strait of Hormuz channel, we're understanding that oil prices could spike over 100. Do you see this as a realistic scenario? And if this happens, what would the global reaction be?
Well, a couple of things. First off, if it was to happen, and that's the big outlier, what would the United States, and remember where it's positioned, you've got the UAE on the other side. I mean, you're talking, Dubai, UAE, you're talking Saudi, you're talking Qatar. Are they got what side of the and there's the wonderful the map, and it tells the story how close it is, that the positioning between UAE and that Strait of Hormuz. So if they want to keep it open, what do they have to do to keep it open? And are we going to see the US have battleships through there, Saudis increase their air defense, all of those issues play out, and that really creates, I think, the choke point that everyone's mindful of. And there's no doubt that everyone wants to keep it open, maybe not Iran in the short term, but that's where the conflict or that's where the pressure will start to build. And, we've got to understand if it goes around the corner there and it comes into Yemen and then the Strait of, the Bab el-Mandeb, then that really creates, again, further issues leading into the Red Sea.
Now, it comes back to that other point, Rahul, which is that crude goes up, bad news for India. But do you think this time it's different? Because
Yeah, absolutely, Raghuj. I think you look at the Indian markets, the volatility of the markets have reduced because globally, the risks most global economies have is the high fiscal deficits they're running, the high debt to GDP. So I think that is a big, big plus. India has very strong macroeconomic factors. And on oil also, let's take a situation that temporarily Strait of Hormuz is closed, oil goes to above $100 a barrel. There's always this thing that US can release oil from some of the strategic oil reserves, etc. So I think it's going to be a temporary conflict, a couple of weeks. It's not going to be a prolonged conflict like what we saw in Gaza. So that's the base case scenario. And coming back to our talk on India, I think India still remains one of the few economies which is continuing to grow at 6% real GDP, 8 to 9% nominal GDP. We've seen huge interest for the market. I think serious pushback is valuation. So any pullback in the market, 10, 15%, people will take it as an opportunity to add to the exposure.
Right, so does that mean, Rahul, the valuations concerns are still there and you're not adding on to any of the positions? Because of late, there's been a lot of sector churning that we are seeing in the markets. A couple of these sectors like IT, this is seen to be making a bit of a comeback. The autos did participate. The bankings and the financials are doing well. Any pockets where you believe that the valuation comfort is still there?
Yeah. So I think what we continue to like is the discretionary kind of a consumption part in India. And our view is, look, this rally which we saw from March onwards was anticipation of rate cuts, which has happened. Recovery is a bit slow, so which is why you'll see pullbacks and you'll use those pullbacks to add to discretionary kind of consumption plays. These are your B2C consumer platforms, the quick commerce platforms, some of these personal consumption platforms, travel, gain, hotels, they look attractive. Some of the infra space also looks attractive. Look, these names got hammered on back of government capex coming down. But look, from last 15 years, we've not seen significant investment, particularly in India's power infrastructure. So that's an attractive story. Outside that, hospitals, real estates are themes which we like. They've done very well between, let's say, 2020 to 24. They may take a temporary breather, but these are strong medium-term themes to play in India.
Peter, I want to come back to you and just get your sense on what the outlook could be when it comes to these energy prices and overall market reaction as well, because over the course of the weekend, despite the escalation we've not seen a significant uptick coming in energy prices or gold. Do you believe the market has largely priced in concerns, or do you believe this is just an underreaction?
I think it's priced it in to a certain extent, and it's new news in a lot of ways, and it's taken the market by force. We're up, the best part of between 2 and 4% in Asia trade. I want to see how the day flows through to pretty much, another 12 hours time, and I'm sitting here now. New York's open, and we're fully engaged with Europe, UK. India finished its trading day, and the impact that we're starting to feel. Do we see further geopolitical powder kegs start to unravel? What's the commentary? All of these sort of things. And don't rule out that China's a main receiver of Iranian oil. We haven't heard any comments from there as yet. So supply disruptions to their market. And, as it says, 80 to 90% of Iranian oil is imported by China. So don't take your eye off that ball. And I feel as though, yes, you could see an uplift from here, again, on time and how much traders want to be, I think, engaged in it. The shorts will get squeezed and everyone seems to be long at the moment.
Okay. Peter, appreciate your time. Rahul, let's just take some closing comments from you. Non-oil, but specific to India. When we spoke to you last time, you were long financials, you were long hospitals. and you were bullish on digital. Digital you've already mentioned, but I just want to understand hospitals. It's a very unique kind of a space, but it's a space where competition is intensifying, return ratios are not expensive, and stocks are expensive.
Yeah. So, Nicholas, if you look at the space, look, most of these hospitals are kind of undergoing brownfield expansions. So, if you see the patient intakes, they're growing anywhere between 8 to 10%. Again, the procedure prices are up 4-5%. So, revenue growth is about 15%. Leave aside this quarter, which has been soft, but revenue growth is 15%. And over a medium term, they should be able to maintain to expand their margins. So, if you look at, let's say, 5 years out, how many sectors are there which are unimpacted by digital disruption, which can give you huge growth rates, and then they have a huge unmet demand. So with the kind of incidence we have for the chronic diseases in India, whether it's diabetes, cardiovascular, and with the aging population, sedentary lifestyles, etc., I think there's a huge headroom for growth for these sectors, and we've yet not fully explored potential of medical tourism here.
Okay. All right. Appreciate your time, gentlemen. Thank you very much for joining us.